Imagine locking into a great fixed rate mortgage, thinking you are set for the next 5 years or so, and then life happens. Maybe you need to settle and move. Maybe you need funds to renovate your kitchen or a washroom, or maybe even for an investment. Or you want to take advantage of the lower mortgage rates available. Or it could be any other reason that requires you to tinker with your existing mortgage. You start exploring that thought, and then you get the bad news. Your current bank or lender is charging you a penalty so high it feels like a second down payment. In Canada, homeowners have paid penalties amounting to 30,000, 50,000, or maybe even higher just to break their mortgage. So, today we are breaking down why it costs so much to break a fixed rate mortgage and how you could avoid or maybe minimize some of the nasty surprises involved. Welcome back to Getting Your Shit Together. Today's episode is all about mortgage penalties. If you're considering refinancing, selling your home early, or just switching lenders midterm, you should not miss this episode. We are going to cover what are mortgage penalties, why they exist, and how they work, the key differences between variable and fixed rate mortgage and penalties associated with those mortgages, big bank versus monoline lenders when it comes to the penalty, and who charges more and why. How an environment of rising interest rate or falling interest rate can impact the penalty cost. And lastly, we will touch upon strategies that you can use to minimize or maybe even avoid penalties altogether. So let's break it down and save you thousands of dollars. So let's start with understanding why mortgage penalties exist. Banks and mortgage lenders make money by taking deposit and lending out those funds, with mortgages being one of the most profitable and low risk ventures thanks to the strict lending regulations in Canada and also the price stability. When a lender issues a mortgage, they expect to earn a steady stream of interest income over the agreed period of the mortgage. For example, if you take a $500,000 mortgage at 5% interest rate for, say, 5 years, the bank anticipates earning roughly 117,000 in interest costs over that period. It's about 23% of the loan amount. Now, let's say you decide to break the mortgage after just 2 years into a 5 year term. At this point, the lender has only collected about $48,000 in interest, far short of the expected 117,000. That means they could be facing a shortfall of $69,000 if they cannot lend that money again at the same rate of 5%. Now, that's not an amount that they will simply write off. When you break your mortgage early, you disrupt the lender's income plan. The remaining balance is repaid, but the lender may not be able to re-lend those funds at the same rate, especially if the interest rates have dropped. Additionally, there are administrative and marketing costs involved in finding a new borrower. To compensate for this potential loss, lenders charge a mortgage penalty, ensuring that they recover some or all of the expected income. In some cases, they may also apply reinvestment fees based on how much time is remaining on the mortgage term. This is why understanding mortgage penalties before committing to a fixed rate is crucial. You do not want to be blindsided by thousands in unexpected cost if you need to break your contract early. Okay, so now that we have understood the reason for the penalty, let's look at how these are derived. The penalty for breaking a variable rate mortgage is typically straightforward. It's 3 months of interest cost on the remaining balance. This makes it predictable and often cheaper than the fixed rate penalties. However, not all lenders calculate this penalty the same way. Some base the 3 months of interest on prime rate, than your contract rate, which is usually at a discount to the prime. So if your lender is charging you on prime rate, then your penalty could be significantly higher. So for example, let's say prime rate is at 4.95% and your contract rate is at 4% because you have a 0.95% discount on it. Your outstanding balance on the mortgage is about $500,000. If the lender uses the contract rate of 4%, your penalty would be only about $5,000. But if they use the prime rate, which is at 4.95%, your penalty jumps to over $6,000, a difference of over $1,000. So before signing on that mortgage commitment, confirm and understand how your lender calculates penalties to avoid slightly higher cost. Now let's talk about fixed rate mortgages. And this is where penalties can drastically change over time, as it is impossible to predict at the time of securing such a mortgage. This challenge arises because fixed rate penalties are calculated using the greater of the 3 months of interest on the remaining balance or an interest rate differential. Now, this interest rate differential is nothing but a calculation comparing the rate associated with the mortgage with the current market rates for that remaining term. I will emphasize the remaining term. So let us break it down with an example. Suppose you took a 5-year mortgage, again for $500,000 in the year 2023 at 5.5%. 2 years into the term, you want to break it. But the lender's current 3-year term is at 4%. We have to look at the 3-year term because that is the period remaining on your current mortgage. The lender calculates how much interest they are losing due to your early exit and charges you the difference in interest payments over the remaining term. This is the difference in interest cost for the remaining 36 months. And that's a big difference. Instead of paying 3 months of interest cost, you will now have to pay the difference in interest cost for 36 months. This could work out to something like $21,600 in the example that we used. 3 months of interest works out to be only $6,500 for comparison. So you end up paying the higher penalty of $21,600 if you happen to have a fixed rate mortgage like we used in the example. Now there is a twist. There is a difference between how the big banks calculate that interest rate differential versus what monoline lenders or lenders who are only in the business of giving mortgages. Okay, so now let's look at the big banks who have an even more punitive approach. So the big banks use their posted rates to calculate the interest rate differential amount. These posted rates are kept, I would say, artificially higher compared to the actual rates customers or borrowers get. And hence, the IRD penalty can be massive. Going back to our previous example, even though you got a 5-year fixed, I'd say 5.5% in 2023, the posted rate at that time could easily have been 7%. And the posted rate on a current 3-year term could be, say, 5.25%, even though the rate being offered to you is lower at 4%. Since the big banks use the posted rate in their calculation of the interest rate differential, the cost difference is calculated at an additional 0.25% in our example, which over 36 months makes the penalty higher at, say, about $25,200 in our example. And that's a difference of $4,500 more than what you would be charged at a non-bank lender or a monoline lender. The difference could be even higher depending on what the posted rates are. And ironically, this is something that has little bearing to what your actual contract rate is or could be. Okay, now that we have looked at how the IRD calculations are done, let's explore why the penalty on a fixed rate mortgage cannot be predicted ahead of time. The challenge comes from the fact that nobody has a crystal ball and can definitely predict if the interest rates are going to rise or fall or remain steady. If you thought interest rates were going to fall in the coming months or the near future, you would most likely not have chosen a fixed rate mortgage to begin with, unless, of course, you were too scared of choosing a variable rate mortgage. So, if you thought the rates were going to rise, but instead they fall, in such a scenario, the IRD calculation is likely to rise depending on how much term is left on the mortgage. And this is because when rates rise, interest rate differential penalties shrink because the lender isn't losing much. They can lend out the return funds at higher interest rate, earning them more money. Contrarily, when the interest rates fall, the IRD penalties increase because the lender is losing out on higher interest payments, making them charge hefty penalty because they cannot lend out those funds again at the higher interest rate. For example, in 2020 and 2021, rates were at record lows. If someone locked in, say, 2% and wants to break their mortgage today, say with 1 year rates around 5.5%, their IRD calculation might relatively be small. They might even be paying 3 months of interest costs as penalty. However, if someone locked at, say, 4.25% today and wants to break it when the 3 year rates drop back to, say, 3% in 2027, they could technically face a huge IRT penalty. And a greater penalty at the big banks, as their 5 year posted rates are currently about 6.5%, even though they are lending near 4% or lower 4 to even maybe even below 4% today. So that's over a 2% discount to the posted rate baked into their penalty calculations. So beware if you are signing up for a 5 year fixed rate with a big bank today. Okay, so we talked about mortgage penalties, the why and the how much. But you are probably wondering if there are ways to minimize or even avoid paying such a penalty. For sure, there are a number of ways to approach, but all of these might not be appropriate to your situation. And so I would suggest that you have a personal assessment done. That said, some of the different ways are, well, if you think you may break the mortgage early, choosing a shorter term, so maybe like a 3 year term instead of a 5 year term, would reduce that penalty risk. So some amount of forward planning is required before you sign up for a term. This is not just about choosing the lowest rate, as the penalty will likely more than offset any savings that you may derive by choosing the lower rate. Go variable if you need flexibility. Now, as you know, variable rate mortgages have lower penalties or as low as they can be with a closed rate mortgage. Choose a variable rate mortgage if you have a strong feeling that the interest rates could keep dropping in the near future, and you're, of course, comfortable with that variability. Downside is you might need to be more vigilant with such a mortgage. Another option you can consider is choosing an open term instead of a closed term. There is zero penalty. I mean, zero penalty to break such a mortgage. However, the interest rate on such a mortgage is generally much higher and so would be suitable only for a short term, maybe a couple of months at max. Or you could look at borrowing on a home equity line of credit instead of a regular mortgage. There is again zero penalty to pay off the balance on a home equity line of credit at any time. So consider such an option for greater flexibility. And these are generally available at, say, prime plus 0.5 percentage, or maybe even slightly lower, depending on how much you're borrowing and what the lender's appetite is. And so it may not be quite expensive if holding for a shorter duration. Well, obviously, pick the right lender. Work with a mortgage broker to avoid lenders with harsh penalties, structures, or maybe even stringent restrictions. Or at least be aware of what you get signing up for because ignorance is not an excuse. You can also consider porting your mortgage if you are moving. Some lenders let you transfer your mortgage to a new property without penalty. You can also look at blend and extend option. Some lenders offer a blended rate, rolling your existing mortgage into a new term with a middle ground rate to reduce the penalties. You can also explore prepayment options. Be aware of your lender's prepayment options and investigate how they could help you minimize the penalty. Again, this requires some bit of planning. So, in conclusion, breaking a fixed rate mortgage can be a financial shock, and many homeowners only realize the true cost when it is too late. Lenders structure their penalty to protect their profits, often using inflated posted rates to maximize what you owe. But knowledge is power. Understanding how these penalties work can help you make smarter financial decisions. Before locking into a mortgage, think about the long term. Ask about penalty calculations, compare lenders, and consider flexibility if life changes. If you're already in a mortgage and thinking about breaking it, run the numbers, explore options like porting or blending, and work with a mortgage professional who can minimize these costs for you. A wrong move can cost you tens of thousands of dollars, but with the right strategy, you can avoid nasty surprises and keep more of your hard earned money. Well, that is the goal here at Getting Your Shit Together. Hopefully, this was helpful.